High mortgage rates, low demand, and even lower supply. The story of the Connecticut real estate market. Hey, this is Dave with the Bolduc Realty Group. Welcome to my weekly real estate market update. Today's September 29th. It's kind of rainy out there right now, and hopefully it clears out for a nice weekend. Going into the key Connecticut market stats. Active on the market today, 4,450. We're up 3 from last week, so I'd say that's pretty flat. We had 294 new listings over the last 24 hours, on par with the typical around 300, so that's normal. We had just under 3,900 closings in August. September, so far, we have about 3,000 closings. Today's the last day for closings, so I do expect to be well below the 3,900 we had last month. It'll probably be 3,200, 3,300, maybe even 3,400 by the time all the numbers come in. Based on August sales, we've got about 1.2 months of inventory, so it's a pretty low inventory position. So we've got some key dates here, and it's actually nice to see a little bit of green on there. The PCE report came out. PCE is the Personal Consumption Expenditure Index. This is the Fed's preferred inflation measure. So the favorable results, which is less inflation than what was expected, is some good news. The PCE, the overall PCE standing at plus 3.9% year over year is also good because that's the lowest inflation number we've seen for this metric in about 2 years. Does this change the Fed's path forward? Does this change what we think the Fed is going to do? Unfortunately, no, it doesn't. The Fed in the markets, I think they're kind of over the short-term blips of, a little bit down, a little bit up. We might see the stock market pump a little bit, the bond market do a few things, but overall, the Fed is not going to change their plans going forward. Inflation needs to show consistent downward trend for an extended period of time. Is that 6 months? Is that a year? I'm not sure, but it's more than just 1 or 2 months. Until then, the Fed has made it clear that they intend to keep the Fed funds rate high. And I still think that there's a chance that we're going to see another increase by the end of this year. It could be, October. It could be the next meeting. So bond rates, the bond market in general, it follows the Fed fund rate, and mortgage rates are closely tied to bond rates, specifically the 10-year Treasury. So as long as the Fed funds rate stays high and the bonds rates stay high, mortgage rates are gonna stay up there as well. So these high interest rates, the idea is to make it expensive to borrow. The higher cost of borrowing slows down spending and slows down the economy in general. Unfortunately, the personal expenditures, personal spending is up again, and it's staying strong. And the other thing is that the initial jobless claims, which come out every week, continue to be below what the numbers are expected to be, what the forecast is. So we're continuing to see a relatively strong economy. What does this all mean for the real estate market? What do all these numbers mean? Well, most homeowners, they're delaying listing their house if they want to sell because they're facing the need to buy another house on the other side and probably finance it. And they're looking at going from a 3% mortgage to a 7 or 8% mortgage. And that's just not attractive. That's causing supply shortages. Buyers, they're continuing to see their purchasing power eroded. The higher interest rates go, that means your mortgage payment is more an interest payment and less a principal payment. And as those principal payments get smaller, you can't buy as much of a house. So they're definitely seeing their purchasing power erode. The net result is we're going to see continued low inventory and then also low demand. And that demand is being suppressed by mortgage rates. Bottom line, we're going to see the inventory position and the demand position in the market that we've seen all along the last 8, 10, 12 months. When interest rates drop again, and they will drop, buyers and sellers are going to return to the market. Now, the question is it going to be more buyers than sellers, or is it going to be more sellers than buyers? What do you think? Do you think we're going to have more buyers come back into the market or more sellers? Drop a comment down below. I'd love to hear your thoughts. Primary mortgage market survey, the average interest rates ran up after the Fed meeting. No surprise there. The PCE report I just discussed is a light at the end of the tunnel. It's kind of dim right now. I just hope that we're not mistaking that for a train that's on its way. The silver lining for the housing market in all this is that mortgage rates have suppressed demand significantly at a time when our inventory position is bottoming out. So just think about it this way. If we had the 2019, 2020 demand and mortgage rates, really high demand, when we had this extreme low inventory, housing prices would be up a lot more than the 6.4, 6.5% they've been up year over year. So that's some silver lining there. I'm trying. As we get closer to the end of the year, the housing market has settled into a pattern of low demand, low inventory. Unless something big changes, this is the pattern we're going to see for a while. I've given my opinion over the last few videos and this one as to what's going to happen. What do you think is going to happen over the next 6 to 12 months? And what's it going to do to the market? Let me know in the comments down below. Hope you guys have a great weekend, and I look forward to giving you another update next week. Have a great day.